Hi, I'm Ben Mulroney from Smart Currency Business, here today to talk about Treasury Management for international businesses who are importing and exporting. Hi there, good morning everyone. Good morning, good afternoon, wherever we are. Thanks very much for coming. I hope you're enjoying the show and you're actually here to listen to us rather than having got lost and found something more interesting to listen to. But you're here now anyway, so hopefully we can enthrall you, amaze you, delight you and interest you. We're here today representing Smart Currency Business. Smart Currency Business, as the name implies, is a specialist currency brokerage and international payment specialist. We work with a large number of corporate clients and private clients across the UK, helping them to better manage their foreign exchange exposures, which I'll talk about more as we go throughout the presentation. However, what we also want to talk about in a lot of depth today is international trade through import and export, how that impacts upon your business, and what we think are the key areas you should be looking at that are often ignored. We partner with a lot of accountancy firms and other specialist providers in this space so that the breadth of our advice is broader than simply offering currency services, with that obviously being a core part of our business. So I'll move through the presentation. If anyone has any questions, do feel free to ask. The more interactive we can make it, the better, or sit back and pretend to listen, and that's all good as well. So, first of all, I want to tell you a little bit about Smart Currency Exchange, our background and history, because I imagine that most, if not all of you, probably haven't heard of our business before. We're a specialist boutique, we don't widely advertise our services, and all of our business comes through word of mouth, referrals, and partnership introductions. So Smart Currency Exchange, the parent company, was formed in 2004, primarily to handle private client business arising from international property purchases. And we are actually the official currency partner to Rightmove International. So that's the origins of that side of our business. Smart Currency Business was formed in 2009 to better service the need of corporate SMEs across the UK. We're the only UK brokerage that doesn't pay its sales and trading staff on a commission-based basis. This is very, very important. If you're employing a currency broker to give you advice around when you should be entering the market, the nature of the contracts you should be purchasing, and how you should be hedging your foreign exchange risks, you don't want that person's advice to be tainted by their desire to book your trade now in order to fill their pay packet at the end of the month. So we've removed that link entirely. And again, I'll talk about that in more detail later on. We think, the leading specialist in the foreign exchange market for UK businesses. We quantify that by a combination of volume of clients, retention rates, and quality advice, and the breadth of our partnership channels. A lot of companies think that they're market leading in what they do. Everyone's got a claim and a reason why they think that's true, so you can make up your own mind. Perhaps let me know if you think that's the case. We are absolutely committed as a business to providing a bespoke service that is very almost old-fashioned. We don't push our clients onto online trading service. We deal with all of our clients over the phone on a one-to-one basis with a dedicated trader assigned to each client. Whilst that might sound almost outdated in this day and age, we think that personal service, personal relationship and advice is much more valuable than simply logging onto an online platform and being told to get on with it yourself. Smart currently has over 2,000 active corporate clients across the UK with no real geographical bias and across all industry sectors. The thing those clients have in common by and large is they very much fall into the SME sector. We're very focused on sub 200 million market cap companies. The main reason being those companies, in our experience, tend to be heavily overcharged and underserviced by the large mainstream providers, i.e. high street banks in this sector. Something we're very, very proud of, and actually for us is more important than the size of our clients, is that we have over a 90% retention rate within our client base, which in our business is incredibly unusual. We've had consistent year-on-year growth since the company has grown, and we think that's largely in part to our word of mouth and high quality nature of our advice and service. We are fully authorised by the FCA as well as HMRC, and we're also fully licensed as a payment specialist, as well as our ability to conduct our foreign exchange transactions as well. But what I also want to talk about today is the reasons why our clients come to us. And believe it or not, our clients don't come to us because they want to trade foreign exchange. In fact, I would go as far as to say none of our clients want to trade foreign exchange in any way, shape or form. I mean, who here does? Did anyone wake up this morning going, I must buy some dollar yen, I must trade some sterling euro? Nobody wants to do it, apart from a handful of people who like to lose money on a regular basis. So why is there such a demand? Because our clients are doing other more interesting things. They're running businesses, they're importing raw materials, they're importing goods, they're exporting services and goods to other clients around the world. Export-led growth is one of the major drivers of growth in the UK economy for SME clients. So foreign exchange arises as a byproduct of other far more interesting things that our clients want to do and are very good at. So as a business, we're very focused on those areas. So international trade, why is it so important? Well, first of all, you may not have noticed, we're in somewhat of a recessionary environment. The economy is not looking very good, but don't tell everyone, it's a bit of a secret. UK exports are worth approximately £40 billion per month, and that number is growing consistently. It's one of the few areas actually the UK economy is proving to be a massive success in, across all sorts of areas. Interestingly, manufacturing is growing. The most recent numbers out this week showed quite substantial manufacturing growth in the UK, which is really heartening to see. It's an area that's often maligned. We talk about the decline of UK manufacturing. Actually, it's on the ascent. We're seeing an increase in that, and especially export-led. We're seeing an increase in service provision being exported out of the UK as well. So there's a lot of very positive stories. 56% of UK firms said exports accounted for over half of their annual turnover, according to the Institute of Export, an international trade survey report. That's a staggering number. I mean, just out of interest, if you don't mind having a show of hands, a little bit of interactivity. Does anyone here have a company that has some kind of international exposure, import, export? Yeah. 62% of firms from the same report said that increasing demand from overseas was driving growth. So this isn't just speculative, we're going to set up an office overseas. This is genuine demand. A demand for UK goods and services, which in many areas is seen as market leading on the international global scale. And 58% of entrepreneurs said exporting has led to levels of growth not possible otherwise. The message there is really very, very simple. For UK PLC, we need to be importing, and particularly we need to be exporting goods and services to other parts of the world where we have a competitive advantage. Now, I'm not going to go into too much depth today, because the scope of today's conversation is to keep this within a 45-minute time slot. I don't want to be up here all day, and you certainly don't want me to be. What I have given all of you out is a Treasury Management guide. Please take that away with you, look through it at your own leisure. What it covers is other areas which we think are absolutely critical when businesses are beginning to import and export. First of all is credit insurance. Credit insurance you may have in place already. The nature of credit insurance on an international basis becomes more complex, more involved, and arguably much more important, and a very different animal. You've got to look at things like, political risk, obviously currency risk we're going to cover today. You've got to look at things like weather risk. You've got to look at logistics. You've got, what happens if your container ship falls over? Now, that might sound like a flippant comment to make, but in a conversation yesterday, I was actually speaking to a client who's had exactly that problem occur in the last few years, and what happens when they have a problem and a container ship is suddenly in port and is being delayed for 3 days. The costs get extortionate. So having that type of credit insurance in place and an export finance in place is absolutely critical. Financing your overseas operation is also very, very important. So as a business, what's very important to us is partnering with other third-party providers. So we have key strategic partnerships in place with credit finance specialists, credit finance brokers and underwriters that provide that service to our clients. So when our clients come to us and say, okay Ben, I want to set up an overseas operation, can you help me hedge the currency rates? Yes, fabulous, and we can help them to do that. And like I said, I'll cover more detail on those operations. What we also say is, can you speak to our accountancy partners? We come to the CPAA and say, who can you recommend for a client who wants to set up in Portugal? They will set up a local accountancy firm. We will get in touch with international credit insurance providers who will set up those operations for them. So we now become a centre for a full scale of operations to help those clients. Because if you make those mistakes in the middle of a transaction, it's too late to fix them. We want to talk to people 6 months, 12 months before you make those transactions. We and our network of partners, we can help you to avoid those mistakes before they even occur. And that is surely the best way of doing business. So the obvious question, and it really is a very big question, why do we exist? Why do our clients come to us to help manage their international payments? After all, HSBC, Lloyds, Barclays are all queuing up to take your business. As a business, you probably have a bank account, you have banking arrangements in place already, so why shouldn't you just use their default services? Well, first of all, the biggest problem we encounter is poor service. And actually, to clarify that in more detail, what I really mean is a lack of service, especially if you are a sub £200 million market cap company. In the majority of cases we communicate, if you go to your normal banking provider and ask them to do your currency exchange for you, one of two things will happen. They will just set up an overseas bank account and the money gets transferred on the day at the prevailing exchange rate, usually with quite a hefty spread on the currency rate. We've seen spreads in excess of 1, even as high as 3%. And to all of you sat here, that probably doesn't even sound that bad. You think, that's fine. And someone gives you a rate, you look at the numbers, it looks about right, you go with it, you're busy, you're doing other things, you don't question it too deeply. Or, they say, here's our online platform, it can do all these wonderful things, go away and do it. Which is basic code for go away, we don't want to talk to you because you're transacting under a certain amount of business. Both of which, in my view, are poor service. And actually, in terms of giving clients access to an online trading platform, in a lot of cases, and I don't mean all, it's a very dangerous solution. You're giving very busy people who are not clued up with the financial markets or the foreign exchange markets access to a tool where they can do themselves and their business an awful lot of damage if they don't know what they're doing. So, whilst it's a useful tool, it can be a dangerous one. Uncompetitive rates and buying at the wrong time. Market timing is a huge risk. And it's a very contentious area because ultimately, we don't have a crystal ball. I don't know what rates are going to do next week. I don't know what they're going to be in the next 5 minutes. But we do look at long-term trends. We do help our clients analyze their business, their cash flows, and help them define what their target rates are, and then help them to guide them through what a good timing for them in the market is. And that sometimes is not always the same time as your transaction. And uncompetitive rates. Why would you pay 2 or 3% for something when you can maybe pay 0.5%? Now these small percentages may not sound much, but if you're paying 400 or 500% more for a service, that ultimately a dollar's a dollar wherever you buy it from, unless you're paying too much for it. So these has a huge impact on your bottom line to your business. And lastly, and actually the area that makes the biggest impact, is a lack of risk management. It's very important that you're paying the right rate, that you're buying at the right time, but also that you have an expert on hand who can look at your business, look at your cash flows, look at your exposures, understand your risk tolerances in the market, and put in place a hedging or a risk strategy that will suit your business. If you don't, you could write an invoice with a client, agree for a payment in 90 days, but if the currency falls by 10% in the intervening time, your invoice is now worth 10% less than it was. That's your profit margin gone. Now, does anyone here work within a business where they can take 10, 20% in their 3-month period, throw it out the window and not care about it? I don't. So it's very, very important that you at least look at these factors. And as we roll through the presentation today, sometimes, and I'll make this a very important point, doing nothing is the right thing to do. As long as it's a real decision, not doing nothing because you can't be bothered or don't know where to turn is not good enough in this day and age. So, what I want to run through very quickly is, first of all, what are the range of options you have? What are the range of contracts and products that we can offer you as a broker that can help you navigate the market? Well, the first and easiest product is a spot contract. Spot contract just means you buy the currency at that point or that spot in time in the market. So it's buy now, pay now, and your broker should arrange to get you the best, most competitive rate they can find for you right now. Very, very simple. And sometimes that is absolutely the right thing to do. Very, very simple. Getting a little bit more sophisticated is a forward contract. Some of you may have has anyone had any experience of dealing with forward contracts or options? Yeah? So a forward contract, to put it in simple terms, buy now, pay later. So you book an amount of currency now, over 3, 6, 12 months, whatever period you think you're going to need it within, and you pay for it when you actually exercise that contract, but at today's exchange rate. So very, very useful if you've got a future requirement, but you want to lock in the rate today, and just remove any uncertainty from the market whatsoever. So for most people starting out in currency trading or currency hedging, those are your basic two main tools you're going to use. How can we make it a bit more interesting and a bit more flexible and suited to your business in that? Well, first of all, let's look at why risk management is really important. So we're starting off with an example here where we're looking at sterling euro rate. We're starting the year at $1.25 to the euro. The client at these 2 points in March and December, or mid-November, has got two payments due. One of 600,000 euros, one of 900,000 euros. So nice simple 1.5 million euros over the course of the year. Now if the client just said, no, I'll leave it, I'll just exchange my money at the point in time when that arrangement comes up, that's absolutely fine. So first time the rate's dropped down, the client has now lost £15,000 by the rate dropping. Okay, £15,000, not a huge amount of money, not too bad. We go throughout the year, it goes up a bit, goes down a bit, the usual volatility. We get to the end of the year, we need to make that transaction, we now lose £75,000. The simple option would have been at the beginning of the year to simply say, I know I have a requirement for 1.5 million euros. I don't know if the rates are going to go up or they're going to go down. But I do know that at the point when I've agreed those contracts, 1.5 million euros is worth 1.2 million pounds. I know that for absolute certainty, and that's what I've based those contracts on. So is there any reason at all why I wouldn't fix that rate now and have absolute certainty? So when I report my accounts at the end of the year, as long as I receive that money, which is where the credit insurance comes into play, but as long as I receive that money, I know exactly what it's worth in sterling terms. That should hopefully make sense to everyone. However, there's two other options you also have. First of all, what if we're in a position where actually I've got an amount of tolerance. I've got a reasonable amount of risk that I can accept in the market. So I'm saying, okay, worst case scenario, I don't want to lose 90, 100,000 pounds as per the previous example. That's a lot of money to lose. But maybe I've got a window where I can say, look, if I lose 20 grand here or there, I can swallow that. I can absorb that loss. But what I would like to do is have the opportunity, if the market goes up a bit, to benefit in that upside. Well, that's fine as well, because what you don't want to do is do nothing, rates plummet, and then by the time you look at them again, suddenly you're 100 grand out of pocket and you don't know what to do. It's a very, very simple solution. We would put in place a series of market orders to buy and sell the market at certain key levels that we've agreed with you in advance. So when we hit a target rate, we would buy the euros for you. If the market falls below a certain level, so we've got it wrong in other words, well, we have a stop loss that sells your euros back at a pre-agreed rate. So we're triggering our losses at a certain level. So if you have a degree of risk appetite, that can be a useful strategy for you. However, both strategies have their flaws. This strategy still opens you up to having losses, and it limits your upside potential as well. So it's useful, but arguably not that great. So what we've developed is an innovative product called a flexible forward, which there's some artificial versions of this in the market, but they come with additional charges and additional mechanisms which make them difficult to execute or expensive to execute. We've developed this flexible forward to give our clients a solution which actually encompasses the positive points of all the strategies we've very quickly rushed over just now. A flexible forward contract is improved forward contract exactly as we looked at to date. So now pay later, we secure a rate today for a future use. And we've looked at a very simplistic example where we have two known payments throughout the year. However, for any of you that do international trade, I'm willing to bet that your business model and the cash flows are neither that simple nor that predictable. Most clients that I deal with, they have multiple cash flows coming in and out constantly. They have multiple beneficiaries to be paid in multiple currencies. And sometimes a contract that you think is going to happen in 6 months' time in 12 months instead, or the amount may change. You may get a last-minute contract that you hadn't planned for throughout the year. So we don't start off beginning of the year knowing exactly everything that's going to happen. So we need flexibility both in the rate, the timing, and how you execute the money orders as they come through in the market. So your flexible forward, very, very simply, allows you to book your rate at a moment in time, It allows you to draw down as much of that contract whenever suits you at the pre-arranged rate with no additional cost whatsoever. So there's no premium, there's no fee for drawing down that contract. All you pay, in effect, is the spread on the currency, which we pre-agreed with ourselves and remains fixed. And so our typical spread with clients is on major pairings, so euro dollar, euro yen, sterling yen, etc., is 50 basis points, not north of 1% as the high street banks will normally charge you. So you still benefit from the cheap rate, you still get value for money, but now you can draw down that money whenever suits you, as much or little as suits you from that contract. So you've got flexibility. The other flexibility you also have is the ability to roll that contract at the end of it, should you have not used all of that option. So let's say at previous example we've booked 1.5 million euros. There may be various reasons why you get to the end of that 1 year period and you've only used €1 million worth of it. Well, you've got €500,000 left on that contract, and you are now legally obliged on a normal forward contract to take delivery of those euros. So first of all, you've got to have circa £300,000–400,000 in cash to settle that contract, which you may or may not have. And even if you have it, you may not want to tie it up buying currency. You've then got to park that money in an account, sitting around doing nothing until your euro requirements come up again. It's not efficient, it's not a smart way to run your cash flow. So we have the ability to roll that contract over. So you simply take that €500,000 that you have left over, you roll that for a further 3–6 months period until such point as you do actually need it at the prevailing rate that you previously agreed. So you maintain maximum flexibility. So again, why is that important? So let's look at this example here, which is starting to, in my view, become a little bit more realistic to how we actually see clients transacting when they come on board with ourselves. So we start off at the beginning of the year, again looking at sterling euro exchange rates. The numbers don't really matter hugely in themselves. We've hedged the rate at 1.09. I've chosen that number because it's the average price during that time period. So it's an arbitrary number, but that's where we've hedged our exchange rate. However, when our first payment has come due at the end of February, clearly it's in our interest to use our hedge rate, because 109 is a lot better than 106. So at that point in time, we want to use our hedged rate. So our flat line is where we want to be. Great. So we use part of the contract to draw down and make that payment. Great. Everyone's happy. Your boss is happy because you can say, look, the rate's 106. We got it for 109. Great. Everyone's delighted. Another payment comes up at the beginning of April. Now the market rate is 1.12. Do we want to use our hedge rate at 109? Well, of course not. Why would you want to lock yourself into a rate that's not as good as you can get in the open market? So when that payment comes up, phone you up and we say, okay, rate's at 112, let's use the spot rate. I mean, the first contract we talked about. So there's no drawback to you, because all you're doing is you're settling a contract in the cash market rather than partially settling your hedge. So it's not costing you a penny more, you're just utilizing a spot rate rather than your hedge. So great. So we've now made 3 cents in our first payment. We've made a further 3 cents now by using a spot rate. So great. So now we're 6 cents ahead of the market without having, just by having the average in our back pocket. And this can go on throughout the year, and you can see by having this average, there's times we're above, there's times we're below, and you use whatever rate suits you. At the end of this period, it's very likely that you won't have used all your contract, because there will be times when it's better to use a spot rate, so you simply roll your contract over, or if the market's moved in your favor massively again, you may back that contract out and rebook another hedge at a more preferential exchange rate. Very simple, and what's absolutely critical throughout all of this process, you're never left on your own to do this. And this is why I think it's so important that we don't just develop an online trading platform, give you access to all these wonderful tools, and say, great, on you go, get on with it yourself. Because I'm sure you can appreciate it's very easy to get these things wrong. And we have clients coming to us sometimes who've been using other services elsewhere, and simple things. They buy euro sterling rather than sterling euro. It might sound like a dumb mistake to make. Do you know what? It's really, really easy to do it. Really easy. You're busy. You're worrying about your orders. You're worrying about your invoices. You're worrying about keeping your clients happy, getting payments out on time. You have to log on to a platform, remember your password, you're clicking around, it's not something you do every day, you get it wrong, guess how much sympathy the bank have got for you? Zero. You've got to go into the market, reverse your position, probably at a loss, and then rebook again, so now you've paid spread 3 times, not once. So these mistakes can be very, very costly. That is why we are absolutely committed to maintaining a voice brokerage, so you know, in simple terms, you phone up, you have a dedicated trader who knows your business. So if you ask him to sell sterling euro when you should be buying, because we know your business, there's a very, very high chance we'll say, are you sure that's what you mean? Because that doesn't make any sense to us. We'll know in advance what your business is doing, why you need these payments in place, what your budget rates are, and chances are you won't be phoning us, we'll be phoning you. We'll be phoning you and saying, we know you've got this payment due, rates are at 112, it's above your hedge, let's grab that now. Or, you're underwater, let's use your hedge rate and let's capitalize in the market now. So we're very, very proactive, and really what we're offering is an outsourced service, which ultimately is, in my view, what most of our clients want. Coming back to my opening point, none of us want to be FX traders. There's something wrong with you if you do, trust me. To sit there looking at a screen with blinking numbers and a wiggly line all day, there's much better ways of spending your day if you can avoid it. So what is the process? Should you come to us, or in many cases your accountant or your lawyer refer you to us through our services? Well, first of all, we will undertake a detailed assessment of your business. So we really want to get under the skin and understand, what are your cash flows? What do your clients look like? And because we're set up as a payment specialist, we want to understand the range of beneficiaries you're paying as well. Unlike a majority of FX providers, we don't simply transfer your money from one currency to another. If you have 10 different suppliers to pay in 5 different countries, we can actually make all those payments for you on your behalf. First of all, that avoids costly bank charges, which can add up over the course of a year. But also, it's one phone call, all your payments are made, all your FX is transferred in one simple call. You don't have to go back onto your online banking platform and make all those payments manually yourself. So we are fully set up, licensed and authorized as a payment provider. So we want to know everything about your business, your risk tolerances, your budget rates, how often do you reset your budget rates, what's the forecastability of your payments, etc., etc. That enables us to then go through a detailed, bespoke risk management process with you to set in place a strategy which is dedicated to your business. Because I can guarantee you, what's good for you, sir, will not be good for this gentleman over here. Your businesses will be different, your attitudes to risk will be very different, and therefore the contracts, the manner in which we execute will also be very different. The reason why we do all this is very simple. You want a simple, efficient process in line with the rest of your treasury management. That is why it's also important as we partner with other providers such as credit insurance, trade finance, logistics specialists. We want to make sure that every aspect of your international trade is protected, planned for, and there is a process in place. And it should be really easy to use. And all we're ultimately trying to do is protect the profit margins which you've put so much effort and expertise into building in the first place, and protect them. You don't want to spend years building a business to see all your profits be lost in a year because you didn't keep an eye on the FX markets. And believe me, I've seen that happen. On the flip side of it, a much more positive story, we had a client recently phone us up, quite a small SME type business, who said that since they've opened an account with us, the cost savings they've made in the first half of the year has paid for their budget for their finance department for the entire 12 months. Staff, overheads, everything. So just their FX savings alone sustains their entire finance department. What a great story to take to the board. Now, I'm not saying that's going to be true of everyone. And in some cases, we go through a comprehensive audit and analysis of a process, and our conclusion is, what you're doing is great. Your current provider, your current team are doing an amazing job, and we can't improve on it. And therefore, there's not a lot more we can offer you. And we're very happy to tell you that. And so whether you're referring a client to us or you're coming to us directly, we're very happy to give you that feedback. As I said, you have a dedicated trader to place your orders, offer updates, and monitor the markets on your behalf. We also provide comprehensive research and analysis to you. We have a daily emailed currency note that goes out. We have a weekly summary that gets sent out. And we also produce a monthly magazine with a overall synopsis of the geopolitical and geoeconomic events affecting currency markets in simple layman terms that give you a good understanding of where rates are going, what our forecasts are, a consensus from all the major banks. Like I say, there's no crystal ball, but it gives you some kind of guide. It gives you an idea of what's going on. Also very, very important is security of funds. It's one of the biggest concerns people have when they first start to trade overseas. You're suddenly having to send money off to parts of the world where you're so far away from the client that if something goes wrong, chasing money and enforcing it becomes very, very difficult. So again, coming back to an earlier point, getting cost-effective credit insurance in place is absolutely critical, because you don't want to be chasing debts halfway across the world and trying to enforce them. You want to be insured, you want to be protected. But also from a currency perspective. You know, thankfully it doesn't happen very often, but we have seen examples in the past where firms have set up without the proper authorization, they look and feel correct, and suddenly people's money is disappearing. So we are fully authorized by the Financial Conduct Authority, as previously was the FSA. We're fully regulated by the HM Revenue and Customs, and also by the UK Transmitters Association as well. So to accept your money, to transfer your money, and to actually do the foreign exchange and provide advice around foreign exchange, we're fully regulated in all areas. Also worth pointing out as well, at no point do we hold your money. All of your money is always held within a segregated client account, and our banking partner is Barclays Bank. As always in a segregated client account. So although we're a very strong, very stable business, if I may say so myself, if anything were to happen to us, if we were in financial difficulty, if our capital adequacy is breached, or if we went into some kind of insolvency, your funds are completely ring-fenced, entirely separate, held via Barclays in your name in a nominee account, and cannot be touched by our business. So at all points in time, your funds are completely safe while they're on our side of the transaction. So really, to go through the benefits that we offered and to summarize some of this, first of all, the top line is the best exchange rates. We will give you the first time, every time, best exchange rate. That might seem an obvious thing to say, but it comes back to the earlier point about removing the link between commission and trading. We touched on this earlier, but again, think about it logically. If your trader is working on commission, what is his incentive? His incentive is that you trade as frequently as possible with as wide a margin as possible. So I'm sorry to say it, it's very, very true this happens. It's very common practice in the foreign exchange industry, among the brokerage community, to lure you in effectively with a very cheap rate. So initially things look great. But at that rate they're probably not making any money. The strategy then over the next 3 to 6 months is to, as you make more and more transactions, gradually increase that rate until suddenly one day you look at it and you say, hang on a minute, that's not where I started. But you kind of don't notice. So they play the same game the banks play. You end up saying, I'm going to shop around. So every 6 months you're constantly shopping around looking for a new service provider because everyone's trying to squeeze more and more out of you. You never build a relationship with a good broker who's going to look after your interests, and the broker does, and the brokers don't have any client retention or any loyalty. So that is the biggest reason why we remove that link with commission payments. Our brokers, our traders are paid a salary plus a bonus directly linked to client retention rates. We want to keep you for the next 5, 10, 20 years as a client and be part of your business as it grows. And that's how we pay our people. It makes a huge difference to the way we do business. It also means when you phone up and you say, Ben, I've got a transaction coming up in 6 months' time. I need this many euros. I've got a supplier to pay in Japan and China. Is this a good time to hedge my rates now? Rather than the default response being yes, because I want your business now to meet my end of month quota, I can actually now give you genuine advice. I can now say to you, actually, for your dollars and your yen, yes, now is a good time. However, for euros, the way the market's trending, I think we should hang on. Put a market order in place to protect you in case I'm wrong, but actually I think there's more upside in the market to come, and we should hang on and see how much more we can create. We'll give you genuine advice. We're not rushing into cracking business. We're confident you'll come back to us at the right time when we tell you it's a good time to buy your currency. Ultimately, you want to eliminate risks. You want to reduce your exposure to market volatility. This is so important. Whether you're a financial controller, a finance director, or you're an accountant recommending us to your clients, you're not trying to speculate on the currency markets. We are not advocating that you speculate to try and squeeze more profit alongside your core business. This is an elimination of risk. This is taking that volatility and putting a straight line through it, so that it's one thing you do not have to worry about. That is the reason why we're here. We also want increased efficiency. You want a smooth, efficient process. You want payments to arrive with your suppliers, with your staff overseas, on the same day, on time, in the right currency, at the right price. We have an entire, very large back office settlement team, and you get automatic notification of all payments sent, again, on the same day basis. If any payment ever goes astray, and sometimes in the international banking system, it can happen, and some of these things are outside of our control. However, we will go the extra mile in chasing down and getting those payments back in place for you as quickly as we possibly can. We don't just sit back and say, hey, not our problem, we've done our bit. That isn't good enough. And you've got a specialist team with a direct line to your trader. You pick up the phone any time. You just want to discuss the market. You just want to talk about where rates are going. How perhaps you're concerned about effects in Cyprus or Greece or anywhere in the Eurozone. Maybe you're looking at the latest employment numbers coming out of the US this week and you're worried about the impact on the dollar and how that's going to affect your long-term exposures. Pick up the phone, we will have that conversation with you. We don't want a transactional relationship with you, we want a long-term value-added relationship. Now, a big part of our business, and the main reason we're here today, is our partnership program. Now, I'm talking to you today, I'm quite sure it's got a very varied crowd. Some of you will be financial directors, financial controllers, working directly with businesses that I'm sure we'd like to talk to you and see if we can improve your processes. Some of you, and a lot of people here today, are strategic partners with us, as the CPAA are, where they will recommend their clients to us, because all too often an accountant is very good at looking at a client's international business and their expansion plans and putting in place a lot of processes to help them. When it comes to currency, and I'm talking about some of the largest accountancy firms in the country, like Blick Rothenberg, Grant Thornton, who we work very closely with, the sum total of their foreign exchange skill set lies with recognizing that, yes, Mr. Client, you have a foreign exchange exposure, and that is a clear risk on your balance sheet, and you should go away and do something about it. And that's it. And the conversation stops at that point. Well, I would say in this day and age, that's not good enough anymore. I think if you're providing professional services to a client, there's got to be a stronger value added. So it makes sense to team up with third-party specialists to provide a full range of services, and that obviously clearly works both ways. And we look to promote third-party services back to our clients as well. So the benefits to your clients, should you wish to refer them to us, are first of all, it's a valuable addition to your range of services at zero cost to yourself. And whether you want to use that through our branding, you want to white label it, you want to co-author reports such as the one I've handed out today, you want to co-author white papers, strategy documents, email marketing. We have a whole team of writers and researchers in-house. We will happily work with you to create a message that suits your clients and co-promotes our business across different sectors. It's a highly professional, personalized service. We are not a sales organization. We are a professional consultancy working with clients to deliver maximum value. We give all of our partners a free currency audit. So even if the upshot at the end of that process is, we can't help you, stick with your current provider because they're doing a great job. Or your client decides they don't want to deal with us, at no point does you or your client pay for our time. We give that up free of charge, and there are quite a number of hours involved in providing that service, because we know, unfortunately or fortunately, depending on your point of view, most people that do get referred to us, we can add significant value. They are paying too much, they're not getting good service. And that's the bare truth of it. Now lastly, I've also given all of you today a copy of our Treasury Management report, which one I hope you find useful. It highlights a number of the areas we've talked about. Gives you an insight, I think, into some of the key areas that should you be starting to import or export, or your clients are looking to. It probably throws up more questions than answers, but I think it's a document that gives you a good starting point and starts to ask the right kind of questions. If you want to have a chat about it in more detail, then myself, my two colleagues at the back, more than happy to have a chat with you. Please pick up a copy. My details are on the front. drop me an email or call if you want to discuss in more detail. But we have also hopefully used our little beeper and got all your details. So we'll follow up and we'll send a copy of the presentation and a digital copy of that report out to you as well. Did everyone get buzzed when they came in? If not, see Adam and Georgina at the back, and they'll make sure that we've got your details and we get those reports sent out to you by email. Thanks very much. We're pretty much on time. We've got 5 minutes left. You can either escape, or does anybody have any questions? Yeah, sure. Sorry. Yes. So the gentleman was asking the range of currencies we trade. Through our banking partners and our wholesalers, we can offer any tradable currency. In addition to that, there's recent developments, for example, in Brazil and China, which have enhanced our ability there, because for a long time there were huge restrictions on the ability to get money out of those countries in local currency. So while we could trade real and we could change renminbi, we often advise clients to use US dollar as a proxy currency because of the difficulty in extracting funds and repatriating from that country. So the quick answer to your question is yes, there's a full range on offer. But if we know there are problems with that particular currency, either liquidity or political based or policy based, we also have the ability to advise on that and offer alternative strategies. Again, it's really what you want to come to us for. Sorry? Yes.
How does it work then? How would the transaction work?
Sorry, say that again, sorry?
My client is account with HSBC.
Yes.
If he lets him buy 100,000 euro from you,
yep.
How would it work?
Right, great question. Sorry, with not being the microphone, So the gentleman was asking if a client has a bank account, say with HSBC or any other bank, and they want to do their currency brokerage through us, how does that work in practice? Very, very, very simple. You have a smart currency account. First of all, in order to book a currency, you don't need to put any money on your account. There typically will be a small margin payment, the initial deposit, of between 1% and 5%, but the bulk of the contract doesn't get paid up front. So you book that currency with us, you remit the amount of margin to us or deposit to us in sterling or whatever currency you wish to remit it in, so entirely up to yourself. Believe it or not, we don't have a problem accepting foreign currency from clients. And that money sits in your smart currency account. At the point when that transaction is completed, i.e. you received euros or received yen, whatever the currency may be, that can be remitted either back to, say, your HSBC account, or to any account anywhere in the world, or even any third-party beneficiary that you nominate to us that you want to be paid. So in practice, you pay us the money, and we pay it out wherever you tell us to. And there's zero banking charge for that process. So our clients don't give up their banking arrangements. We're not offering an alternative banking service. We're just outsourcing the FX part of it.
If you just have, when you deal with private individual, you just have one large transaction. Say they want to transfer dollars from Dubai to here.
Yes.
And they're going to bank account with Lloyd's Bank.
Yeah.
And they're going to give you a very bad rate.
Because it's what they do,
Dirhams to US dollar and then to sterling.
Correct. Yeah. It's a really, really good question, and there's two parts to that question. I think what you're asking is, if a private client's got a single requirement, first of all, we do have a private client division. So whether you fall into our corporate trading team or our private client trading team doesn't change the rate, doesn't change the service in practice. In terms of does trading exotic currencies change the margin at which we can trade, the quick answer is sometimes it does, because as you've rightly alluded to, almost all currencies around the world are crossed against the dollar. Well, it's not exotic. When I say exotic, I mean it's crossed against the dollar. So that can slightly push up the margin you might pay, but we'll still be significantly cheaper than using a bank. But yes, that can have an impact. You're absolutely right.
How big are you? How many people do you?
We employ about 60 people. We're expanding very rapidly. Our turnover is increasing by about 30 to 40% per year. Has been year on year since we launched. This year we're on target to trade about a billion sterling in notional currency.
You're based where?
We're based in London, in Hammersmith. Yeah.